Hey everyone, I'm Jerry Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. And today on the show, we're looking at some major shifts in the foreign exchange and in the bond markets. Now, the U.S. dollar is climbing as Treasury yields hit a one-month high, reflecting a cooling labor market and a recent four-year low in the ISM Services PMI data. Now, this could signal an economic slowdown, prompting questions about the Federal Reserve's next move on interest rates. And as we look at currencies, the Japanese yen has dropped to a 38-year low against the dollar following the recent shakeup in Japan's top currency officials. Now, there's a lot of speculation here about what the Bank of Japan might do next to stabilize that currency. And political uncertainty obviously is front and center here with the political impacts from the upcoming elections in the U.S. We got the U.K. and we have France, not to mention the uncertainty over President Biden's future. So what does this all mean for the foreign exchange currency markets? Well, to help us break down these developments, we have Adam Button. He's the chief currency analyst and the managing editor at ForexLive joining us. Adam, welcome to the show.
Hey, thanks so much for having me on.
Now, we were talking a little before. It's a bit of a busy news day. We got lots to get to, but let's start with talking about the recent data suggesting that the U.S. labor market is cooling. I mean, private payroll gains, mainly in leisure and hospitality, while wage growth has slowed. The ISM Services PMI also hit a four-year low. So I guess, before driving in here, Adam, I mean, how do you see these developments impacting the Fed's future rate decisions? And more importantly, what does this mean for the U.S. dollar?
Right. This is a classic cyclical slowdown. It always looks like the economy is holding up for longer and stronger than it seems until the wheels start to fall off. And it happens slowly at first, and then it happens a lot more quickly. And then we find out that the Federal Reserve is behind the curve. And I think in this instance, it's going to be especially damaging for the Federal Reserve because I like to use the expression, generals always fight the last war. So they're fighting inflation, and the market is telling you right now that inflation is yesterday's story. And they're going to continue to fight inflation as growth deteriorates and deteriorates. So say we even get a cut in September, which right now is priced at maybe 25, 30%. Well, that's still taking rates down just a little bit from extremely high rates. And I think they're going to stay in that sort of scenario. And other central banks might be quicker to catch on and cut rates a little more dramatically. And in that sort of scenario, we have ongoing US dollar strength. And that's been the trend now for 4 years. But it's hard to get away from it given everything that's unfolding. And the U.S. is still the cleanest dirty shirt. And, all roads sort of lead back to it against most of the currency field as we enter a cyclical slowdown.
Yeah, you mentioned it well. I mean, it is a cyclical slowdown. And a lot of the data is kind of pointing to it. And, we talk about the ADP report showing a slowdown in job growth and then these rising unemployment claims. Jerome Powell's talked about really trying to be careful and not moving too fast and being too hesitant. This latest data, I mean, you nailed it on the head here. What are we going to do? I mean, are they being overly cautious here, or do they got to be more aggressive in cutting rates?
I think that what they should do and what they will do, right? What they will do is be overly cautious, and that keeps that growth slowdown happening, right? If they're always behind the curve, then rates are never low enough, and then growth continues to disappoint until you're in a place where rates need to go much lower than they otherwise would have. So right now they're talking about a floor at say 3.5% Fed funds. I mean, I don't see why they can't get back to 1% as sort of we get into the second half of the decade or even 2026 at the earliest, when it's obvious then that we're back in this low deflation, low growth world. And that I think is where we're headed, and something like gold can do really well in that kind of scenario. But we are going to have this growth disappointment first. And the problem is that you get a sort of sell everything kind of mentality as we delve into that, and that's what I think it has to happen first. A lot of kicking and screaming and over leveraged markets, and I think that's sort of the first chapter in this next story.
Yeah, we're certainly starting to see the cracks now. I mean, the Japanese yen has been under significant pressure, reaching a 38-year low against the U.S. dollar. When I talk about Japan, it's important to mention it's the third largest economy, and it's usually a safe haven too, right? And you kind of talked about it. Japan's new currency diplomat, Atsushi Mimura, I hope I pronounced that correctly. I love Japan. He's got a tough job ahead. So talk to me a little bit about the factors behind the yen's decline and what strategy Japan might use to stabilize it here.
Yeah, it's a bit of a panic situation in Japan. There was a time when people thought they wanted to weaken the currency. It's a great exporting nation, and that helps a lot of their exports, but to a limit. I mean, they're already in a sweet spot on the exports, and now it's declining and declining, and people are upset about it. Voters don't like it, and companies are importing as well. And so they had this strategy where there was like tough talk, and eventually Kanda was the name of the old currency diplomat in charge of intervening. And then last Thursday, he came out with these very strong words, and the market, the yen went up like 20 pips, which is a fifth of a cent, and then just blew up right in his face. And the market just said, you know what, we've heard it all before. And even if you do intervene, which they launched $60 billion into the market, and it kind of helped for 2 months. And so he kind of lost credibility at that point, and they made the right move in replacing him. So now you bring in someone else, right? So what do you do if you're him? Well, yeah, you can throw more money at it. You throw another 60 billion, you maybe buy 1 month this time, because the market's smart. After falling, it was like 800 pips last time it fell. The market's going to buy the dip a little bit more aggressively because they've seen the playbook before. So now it gets very expensive to buy time. And I think their best strategy, though, is to buy time until the U.S. cyclical slowdown becomes more clear. And, that it's a timing thing. I think that's probably something closer to year end. But do you want to spend, maybe 60 billion a month until year end to keep the currency really where it is? I don't know. Is there something else in the bag of tricks? I think the market has seen a lot in the past about currency intervention and what's possible. So it's tough to find a way for them to make a move here. Your best bet if you're them is to hope for something on the US dollar side, because otherwise we might just keep on rolling here in dollar yen.
Yeah, you're not kidding there. Okay, let's switch over to the US dollar side. I mean, a lot of politics happening in that country. US political landscape is kind of in flux, and there's speculation about President Biden potentially dropping out. Talk to me a little bit here. How do you see this political uncertainty affecting the markets, particularly gold, the US dollar, and kind of looking ahead here, Adam? What are you watching for?
This is one of the all-time great moments in U.S. politics in our lifetime. We may have the big change here. If you look at betting markets now, they're better than even odds that Biden is out. And, the next step, it looks like, is they're going to try to rally around Kamala Harris. And I think there's an obvious reason for that, is that when you donate to a campaign, you donate to the Biden-Harris campaign. And they have $240 million right now. And if Biden drops out and it goes to Harris, that's fine. She can spend that. And politics, it's a big money game in the U.S. If it's anyone else, that money has to be returned. So it's really Kamala plus $240 million against anyone else plus zero. So they're going to try to rally around her. And we'll check the polls after a month. And if that doesn't work, then I think it's on to plan B. And that's something at the convention, which is the 19th to the 22nd of August. Now, between then and now, we're going to be in a tremendous amount of uncertainty. I don't think Biden can come back from this, and the polls for him will keep getting worse. Now, we're looking at gold recently. We've seen a pop, and it takes a lot of U.S. political uncertainty to drive gold or a sustained gold bid. But I think we've crossed that threshold now. And, I think in terms of the U.S. dollar itself, it's a little bit more complicated. You might be more inclined to see yen or Swiss franc strength, which are more of a traditional safe haven. But it's very in flux. And I think markets right now, there's a little bit of paralysis, because you can outline a lot of scenarios where, Republican sweep is more likely, maybe even with Harris, than Biden, or certainly more likely than it was a week ago with Biden. And we saw rising treasury yields on that and a rising US dollar, because you have, a united Congress on that can cut taxes, probably fuel inflation a bit more, run larger deficits. Whereas if it's a split Congress, and I think that's the way to look at this, is split versus divided one way or another, then you have real gridlock. And gridlock right now means less spending. And I think you have lower growth and lower treasury yields, and ultimately a lower dollar. So that's the way I'm trying to frame it. But there are so many moving parts here that it could all change in an hour.
Yeah, Adam, jump into that a little bit more on the details. You talked about that Republican sweep. If that happens, how would the markets react in terms of fiscal policy changes? And what do you think that would do for, interest rates, inflation, et cetera?
Yeah, there's so much talk about the presidency, right? But I think the more important thing might be the House here. Even when Biden was trailing and it was assumed to be Trump, a lot of congressmen run ahead of Biden, and they still had a very good chance of holding the House. And, I think the Senate is Republican. That's probably a foregone conclusion. But, if you have the sweep, the Republican sweep, we have these Trump tax cuts that are set to expire. And that's it. So the reverse of that would be a corporate tax hike as those are eliminated, right? So you have pressure on stocks on that. Now, you also improve the deficit situation. Now, if you have a sweep, you might even have further corporate tax cuts, right? And you would have those sort of strong economy, strong growth. I think there's a line of thinking that says Republicans have lower deficits, but I don't think markets buy that anymore. And I think you have higher deficits. That's why we saw bonds selling off immediately after the debate and through the next 2 days, even though in that time frame we had lower U.S. inflation numbers. And so, this sweep mandate, and we saw it after the first time that Trump won, right? He won, but he also won the House. And we saw an incredible rally in equities and ultimately a strong dollar until COVID unwound everything. So that is the way I would trade this right now. And, you're going to have to wait and see some polls on Harris if she does drop out. If Biden sticks in the race, I think that is the trade to higher bonds. So you're selling bonds, you're buying the US dollar, and you're pricing in higher US inflation. And I think that's pretty clear if Biden stays in the race.
Yeah, well said. Okay, switching over to Europe, there's a lot of things going on there in terms of political uncertainties as well. Plus, you add on their economic challenges into Europe, and I'm curious, what are you looking at here, and what factors are influencing the euro's performance in the near term?
That's it. The massive political uncertainty in 3 of the 6 biggest economies in the world right now. The UK election's a foregone conclusion. Labour is going to have its biggest win in, I think it's close to 200 years. Pretty much 4-1, that'll outnumber Conservatives when the dust settles. If that's a little higher or a little lower, I think it's inconsequential. The UK, you can argue now, is coming out of this will be a little bit of an island of stability. Yes, it's a new party, but it's Labour. They've passed the baton back and forth forever, and he's not promising anything while on taxes. So it's kind of the status quo. Now, the UK does have plenty of challenges, but it has a few things going for it, and political stability might count for more than it used to. So I'm increasingly optimistic on the pound. Now, France, we have a pretty good idea what's going to happen, but it could take a while to sort itself out. And you have all these winds of political change in Europe. And I'm finding it very difficult to embed. There's not a coherent strategy on tariffs right now. They're getting hit by China and the US, and Trump's probably going to double down on a trade war with Europe. They don't have a coherent energy policy. I think, coming out of the weekend, in elections in general, you get sort of a sigh of relief in market. We saw French stocks on Monday try to rally on that. The sun always rises on Monday morning and after the election. And so I think we're likely to see that maybe early next week in France, in all of Europe. But I think that's pretty fleeting, and I wouldn't like the euro above 110, say.
Interesting. Okay, well, you don't want it above 110. The euro can maintain its strength against the dollar here. I'm wondering, what this cautious stance is all about in Europe. It's like you said, we're almost at kind of a crossroads here where we don't know what we're going to do going forward because we don't know what political party is going to be leading those, the politics behind it.
Well, that's right. So you have Europe right now. It's clear Macron kind of bet on this return to the middle. Enough people would come back to the middle. And instead, it's just been a splay to the left and to the right in France. And I think the same thing will happen throughout Europe. And I also find it interesting in the UK that you have the 4 leading political parties. None of them are campaigning on more immigration. They're all campaigning on less immigration. So that's which way the wind is blowing in really the whole world. And so I assume it's some kind of splintering in Europe. In Europe, it's through the dawn of the euro has been really cohesive politics throughout Europe. And that's ending. Now, there are ways that could be good, but it's going to take so long to unfold. and the economy isn't strong to begin with. Christine Lagarde this week, the president of the ECB, was asked about AI. And the first thing she said, the very first thing she talked about was regulation. And that's Europe. Like, Europe just wants to regulate everything while America innovates and China duplicates, as the old expression goes, or replicates and copies. So, I can't get bullish. Euro can get so cheap that it becomes compelling, but that's a trade. There's nothing to invest in. Even you look at the UK, if you like the UK, take a gander at the stocks in the UK index. It's like grocery stores and utilities. Like, there's nothing worth investing. It's banks that are struggling. There's nothing worth investing in there. So it's tough to get bullish on Europe, any part of Europe for the long term.
Yeah, especially behind all the politics taking place. So many uncertainties. Okay, you touched briefly on gold, Adam. So before I let you go, I got to talk about it. We just talked about this current global landscape. It's a little bit crazy out there. What's your outlook for gold prices in the near to medium term?
I think it got, my inclinations that it got a little bit over its skis as we got up towards 2,400, and that we'd be more likely to see a pullback kind of the 22, 2,100. And that's where I'd love to see it to buy gold. That said, it's not, this political uncertainty is real right now. The dollar can strengthen. I worry about a big downshift in risk appetite, and that pulling a lot of the liquidity out of market and weighing on gold. But, if I back it out, I want to buy gold because China, Russia, Turkey, the Middle East are all buying gold, and India, and they will continue to. And so it's just a matter of what sort of dips that you're waiting for. I like this sort of seasonal setup towards October, November, and I would love to see a dip here. But in this kind of environment, and even some of the latest bids we're seeing in gold, I wonder if this turns into a rally that and the most powerful rallies are the ones that everybody has to chase as they go higher and higher. And, a lot is lined up for gold to make that happen. So I think you are either bullish on gold or you're on the sidelines and look for a small dip to buy. But the chance of it going below 2,000 is, I think, pretty close to nil.
Okay, well said. I mean, in the context of these safe haven flows, what we just talked about, do you believe traditional assets like gold, and you mentioned before the Swiss franc, do you think this is going to outperform, or are we seeing emerging market currencies and assets gaining favor due to their higher yields?
Yeah, I think in a cyclical slowdown, you can't be in emerging markets, unfortunately. I think there's a lot of value out there, and I think there are some commodity exporting emerging markets that are interesting. Because I think we're in still a bull market in commodities that will take a break for the next year or so, but there's going to be a lot of green transition spending. There is a lot to like in some of these emerging markets. The Swiss franc, though, in an environment of political uncertainty and especially when you have Japan threatening to intervene, it's in an incredible place. Yes, they're cutting rates again, but as everyone else cuts rates and we see clear signs of a cyclical slowdown, it also stands for stability. So to me, that I think is the next trade is the Swiss franc in a big way, and it's going to cause big headaches because they don't want a strong currency either.
Yeah, as their central bank continues to watch this closely. Well said. Hey, appreciate this. Adam Button, Chief Currency Analyst and Managing Editor at ForexLive, joining us today from Toronto. Appreciate your time, man. I hope you have a great week.
Have a happy weekend, everyone.
Yeah, appreciate it. Thank you so much. I'm Jeremy Szafron. For all of us here at Kitco News, we want to thank you for watching. Of course, hit that notification button. We'll be in Florida next week at the Rule Symposium. You won't want to miss the content coming from that show. We'll see you next time.